The Federal Reserve isn't just part of the reason why things are so out of whack, they are the reason. The more time that passes, the more intervention that occurs. The more intervention that occurs, the worse things get. The more wealth inequality, the more division, the more distortion. This cannot be resolved by applying more of the same. It's simply impossible. The next financial crisis, Jerome Powell has already testified in front of Congress that the Fed will use QE aggressively. We can only imagine what will happen to the value of your hard-earned savings. You came here for the truth, so let me unveil that for you. Another day has passed and we have more Jerome Powell in the Congress testifying. I couldn't even get through an hour today. It was actually much less. I pulled up some quotes for you. I thought it was interesting because he had something very important to say about quantitative easing. We're going to get into that. I'm going to talk about so many different factors. I think I have approximately 25 tabs open right now. It's going to be one of those videos. Stay tuned. I promise a jam-packed episode. Let's get into it right away. Charlie Munger, who you might know, Berkshire Hathaway. Some think that he is actually the real brains behind Berkshire Hathaway. Regardless, doesn't matter. Charlie Munger warns that there are lots of troubles coming because of too much wretched excess. This is a person who is very knowledgeable. Say what you want about Berkshire, say what you want about Warren Buffett. These individuals are very well read. They read all day, every day. They know what's going on in the inside of all of these companies, and they are certainly insiders to one degree or another. Now, you can look at their performance, you can judge them on any which way you want, but they have been in this game for decades and decades and decades, unlike many of the Robin Hood type investors that have just gotten into the game in the last few months, or maybe, this current cycle. This is a whole different story for people who can actually persist throughout the cycles. That's a big difference. He was basically ripping on a lot of what we're seeing today, particularly with the calculation of earnings and how these companies like to talk about the fantasy land. He's got more detail in there. I don't have time to get into it, but I just thought it would be interesting to start the video off that way because even somebody like this is calling out these corporations, which I think is really good. Carnival stock rally is a sign that this market is driven by hope. That's according to Jim Cramer himself. I thought it was really good because he's actually talking about how this doesn't really make sense right now. This is all based on hope. There's more detail in here, and of course he likes to sugarcoat it, but I thought it was interesting. You got some serious problems right now. You have disruptions of all kinds. Factories and different companies. USPS happens to be one of them. There is a serious impact that is felt that is being ignored. These are some previous examples of the Federal Reserve talking about inflation, how they want to make sure inflation goes higher. That's right, the amount that you pay for your food, which the Federal Reserve says increases by 1.6% per year, which is an absolute joke, they want that to increase. The price that you pay for your energy, they want that to increase. The price you pay for your healthcare, guess what? They want that to increase. It is worrisome, in their words, if it doesn't increase substantially. Think about how crazy that is. Real Investment Advice pulled this list together. This is not a comprehensive list. This is just a few examples. Check this out. Jerome Powell, November 2019. That is why it is essential that we at the Fed use our tools to make sure that we do not permit an unhealthy downward drift in inflation expectations and inflation. A month later, in order to move rates up, I would want to see inflation that's persistent and that's significant. You better believe it, that's for sure. Been very challenging to get inflation back to the 2% target. Jerome Powell again. Ms. Yellen also said that continuing low inflation regarded as a boon by many could be dangerous. That's right. If you have too low of inflation, not even deflation, but just too low in their own words, that is dangerous. One way to increase the scope for monetary policy is to retain the Fed's current focus on hitting a targeted value of inflation, but to raise the target to say 3 or 4%. That was helicopter Ben Bernanke. That's right. You raise it to 3 or 4%. Hey, why not? If your inflation doubled, even in their fake way of looking at it, doubling, that would mean a significant impact on your life. Further weakness in inflation could prompt the U.S. Federal Reserve to cut interest rates even if economic growth maintains its momentum. Think about this for a second now. They're going to cut interest rates. Everything is booming right now according to their measurements, and they want to cut interest rates again. That's how intense this has become. There's more in here, but I need to move on. You could see the most important chart I think we need to focus on, at least for the Fed, and what had happened at this testimony is nonsense for the most part. And instead, we should have been talking about this. US financial assets are now 5.6 times the GDP. Look at this. We can see that over this period from the 50s up until the 90s, there was a general range here and approximately, let's say, 2.5 to 3.5 or so. And now today at 5.6. It went absolutely insane as of the 90s. What was happening here, of course, was the lower interest rate environment. We had the financialization of absolutely everything, derivatives, and so on. But think about this. If you look at this range right here, what do we have? Potentially regarded as the best economic growth ever. All right, 50s and on, things are booming, things are growing, expansion, economy is getting better and better and better. And then we get into the 90s, mid 90s, and once we hit 2000 especially, things really started to change. It wasn't the same old story. So we keep hearing about how fantastic what we're dealing with today is, and yet if you compare it using this metric from the 50s to the 90s, things are way out of whack. And why isn't this talked about? Why is this always swept under the rug? Check this out. Rich countries tend to have a bigger middle class, except the United States. The United States has a very big problem, and you could see it right here on this chart. I'll pull out the highlighter so you could see it specifically. The USA is here. And what we're looking at here is a share of population in middle income households and annual median income. So right here, the middle income share percentage, and the USA, it looks to be approximately 50% or so. And at the bottom, we have the median income, and they are not in a good position right here. At the very end over here, we see a country like Norway, for instance, that is certainly faring better than the USA. You can look at the chart for yourself. But essentially what we have here is the extremes in the United States. Massive extremes. San Francisco happens to be one example. You have New York as another example, where you see these beautiful big towers, billionaire row, and then turn the corner because there's mass poverty. And that shows you something is wrong. Something is very, very wrong. The Federal Reserve doesn't understand something, or at least they bold-faced lie to us. You could see the core PCE rate, which is the red line, measured against the core CPI. Now, I don't believe the core CPI either, okay? Just let's be clear about that. But at least it's slightly more accurate to reality. The core CPI is sitting at about 2.25, and the core PCE is at 1.58. That's not good because there's a big difference in between these two. At one point, they were actually accurate, meeting up with each other, throughout 2011. They were pretty close this period of time. And then we can see today a massive divergence. The measurement in which they use to determine the personal consumption for the average individual is nowhere near reality, and that should be frightening to most people. Look at this. It's very hard to say at what level you get concerned, talking about the debt currently. I would say I would be concerned now. It's really the rate of increase. What we need to do is to have debt grow slower than the economy. And that's why they want fiscal stimulus. They want the government to pump money into the system and do it through every means. He's saying basically, we can't do everything. We are not able to actually handle all of what you want. To simply print money out of thin air, pump it into the economy. It doesn't work like that. We buy a whole bunch of bonds and we bail out banks. That's the way it works. There was one good tidbit of information from Powell's testimony: how the Fed will fight the next downturn, large-scale asset purchases. Can you believe it? They'll use QE to, quote-unquote, save the financial system. Powell says the Fed must use forward guidance purchases in future downturn. Quote, our traditional tool, of course, is interest rates, and low rates are not really a choice anymore. They are a fact of reality. I'll stop right there because I simply can't go on without ranting. Take a look at what he just said. They are not a choice anymore. They are a fact of reality. So expect rates to continue for the foreseeable future at historic lows. Maybe they'll even have to bring them down even more. Who knows? They'll make any excuse. Well, you know what? We saw some concerns over in another country, so we're going to decrease rates again and fuel this even further. They don't ever get enough until something pops. And then they can say, well, you know, we did everything we could. Now it's all on you, government. Now you need to fix the problem. So we will have less room to cut. How many times have I talked about that? You've heard it here. I know you know that yourself, obviously. That means it's much more likely that we'll have to turn to the tools that we used in the financial crisis when we hit the lower bound, which is forward guidance, which basically means nothing except they just keep saying we'll print more money if we have to, which says it will keep rates low. And then it's also large scale asset purchases of longer term securities to drive longer term rates down and support the economy. It doesn't support the economy absolutely whatsoever, as we have seen. I proved that to you a moment ago, but that's what they say. We want to support the economy. Support the stock market, maybe. The economy, no. Doesn't work like that. We will use these tools, I believe. We will use them aggressively should the need arise to do so. The Federal Reserve will use QE. Remember, this is what this is. QE, in their own words, not even QE4, which they refuse to admit. We're talking about QE, and they'll use it aggressively. The fact that they're willing to use that term aggressively, I can only imagine the speed at which they will be pumping out the money will be like nothing we've ever seen before. Here you have an admission to the Congress themselves. It's not even as if you got to put some puzzle pieces together. They're saying it. There's no need to do that now, but we will use those tools aggressively. That, I think, is so important. It was largely overlooked, although you can see it is in the mainstream media, but they're not talking about it. The stock market doesn't give a damn anyway. Powell suggests that the Fed might lack ammo to combat the next recession. And you could see at the bottom here, the current low level of interest rates means it would have to rely on the fiscal policy to support the economy if it weakens. Okay, so we talked about that just a moment ago. Now look at what's happened with stocks. You can see these tech stocks that have done so well. I mean, so well. Microsoft, Apple, Google, Amazon, nearly $5 trillion in market cap, or 17% of the S&P. Is it different this time? We have seen this before taking place, where so much money flows into fewer and fewer and fewer and fewer stocks. I talk about the narrowing band many times, and you've seen it here on the channel. And I was talking more about the tech stocks, and we looked at this narrowing band, and fewer things were happening, and now it's down to 4 stocks. I mean, are we serious right now? This is crazy and is extremely dangerous, and you know what's going on here. Power in fewer and fewer hands is always dangerous, but people will throw their money into these companies and not blink an eye. Tech company acquisitions since 2010. Look at this: Alphabet, Amazon, Apple, Facebook, Microsoft. You could see through the years 2010 to 2019 gives you all of the breakdown right there, and it's extreme. And the question I have is, what exactly is the purpose of these acquisitions? Sometimes I really worry. I'm not going to talk about the details of that, but sometimes I really do worry. It is concerning. I have a couple charts here on options. Basically, what we're looking at right now is that these investors have been putting a lot of money into options with the hope that they are going to go higher. That shows me that there's this risk on mentality. It proves that right here in another way. I'm not going to get into all the details of these particular charts. It's just too much to get into. I'm going to run out of time. But look at this really quickly. Single stop options, notional volumes as a percentage of shares notional have risen to 91%, well above the previous highs. You could see from 2006 up until the present, it's gone absolutely insane right now. And which stocks are we talking about here? Well, obviously Tesla, Amazon, Apple, Alphabet, Microsoft. You've seen it all. You know the details. You know the drill by now. Broken down by sector, you can see the consumer discretionary, information technology, communication services, and so on. These companies obviously occupying most of it. Looking at the different tickers, we could see the ETFs broken down, whether that's in the S&P 500 or simply the QQQ that everyone loves to invest in. That's all here detailed below. And now we look at the real economy, specifically with EU industrial production. It has been beaten hard, all right, beaten hard. Haven't seen these low levels for this length of time since the sovereign debt crisis. There's a couple charts following this. You're looking at the Eurozone industrial production month over month. Again, falling to levels that we haven't seen since the financial crisis. And then we have same thing year over year, that weakness, same as what we saw financial crisis and the sovereign debt crisis. Here you can see the comparison between the industrial production and then the German stock market. Something is definitely going on. These should largely be moving together, but you could see the mass divergence in between the two, which signals we got some serious problems. And this is just some information that nobody cares about. US deficit surges 25% in fiscal 2020 and is $1.1 trillion over the past year. Nobody cares about the deficits anymore. Nobody wants to talk about it. I just put it in here for fun at the end so we can all have a laugh. Because let's just hyperinflate the currency. Why not? The Fed is going to save the day. That's all for this video. If you found it informative, if you found it jam-packed, give me a thumbs up. If you hated it, if you hate my voice, you think it's too slow, you think it's too fast, you think it's too up, you think it's too down, hit the thumbs down button. I'd appreciate that. Thanks. If you want to learn about how to sell on Amazon, how to sell in e-commerce, you want to understand e-commerce, what it's all about, but you don't want to actually pay money like these courses out there charge you $1,000, $2,000, I created a free e-course for my subscribers for this purpose. You can learn for free. TheAmazonGPS.com. All right, hang on. These two books are so important. They're so integral to understanding everything. And a lot of people, they don't want to read. But for those who do, I know you will get so much out of these two books. And the best part about these is that they are excellent to give to somebody else after. You hand it to somebody else that you think could benefit from the information. Definitely check them out at the link in the description if you want the audiobook, themoneygps.com. This video right here you're looking at was so jam-packed with data, and yet only a few people watched it. I don't understand why, but you will get so much out of it if you watch it. Click on it. I'll see you there.